What's broken in investing in Indian market today?
You go to a car dealer to buy a car. Now, whether you're stretching your budget to buy it or not, they don't have an incentive to care about it.
Can I really trust AI with my financial decisions?
You can't just take a portfolio, dump it into GPT and expect to get great results.
What diversification is all about?
Diversification is the only free lunch in investing. Let's say you're an ostrich investor who never touches the portfolio. You have made net no return in 2 years. Now, let's say you were letting Otto do your rebalancing for you. Your net return is at 25% CAGR in this.
I would only want to pick the growing stocks.
If you see a straight curve producing spectacular returns, that's basically a fraud.
There are so many mutual funds to choose from.
Should not be a sorting investor. Otto has an algorithm called RAM, which is used to rank mutual funds. RAMP, Risk Alpha Management Portfolio.
So you talked about, HA3, RAM, all these models.
These are actually institution grade models that are simply not available to a retail investor and most often not even to HNIs. Selling commission-led products, AIF and PMS to HNIs is more profitable than building all this.
Welcome to this podcast. So today we have Apurv Gupta, an established entrepreneur and a successful technologist with us today, who is building something very unique in the cluttered fintech market and using AI. Apurv has successfully launched multiple scalable solutions in technology at Google and lastly as CTO of Cohesity, which is a $7 billion company now. Welcome Apurv to the podcast today.
Thank you, Manish.
So jumping in, what's broken in investing in Indian market today?
From the perspective of Indian investors, I see three big problems. One is noise, second is choice, and third is mis-selling. Let me cover all of them.
Mm-hmm.
So the problem of noise is quite apparent. They are bombarded whole day on TV and social media with news, Trump did this, and they keep worrying about, how to react to it.
True.
Wealth is not made by reacting to noise, but actually ignoring noise and looking at the signal. The second problem is of choice. Indian markets have become very wide and deep. There are now more than 2,000 companies listed on NSE alone. There are a wide array of products. So now investors have the problem of choice. EPF, NPS, bank FD, commodities, small savings, direct equity, mutual fund, PMS, AIF, SIF, so on and so forth. Right? The third problem is of mis-selling. So when Indians go out to get any financial advice, most of it is commission-led in India. So let me give you an example. You go to a car dealer to buy a car.
Mm-hmm.
The salesman over there is working not for you, but for the dealership and for themselves. They have an interest in upselling you a car.
Correct.
Now, whether you're stretching your budget to buy it or not, they don't have an incentive to care about it.
True.
Right? And, this misalignment of interest happens in financial products also. I'll give you an example. A close relative of mine, a 72-year-old gentleman, he saw on TV in 2024 that India is a structural bull market. It's going to do very well for the next 20 years. There were TV campaigns, mutual fund sahi hai. So he went, where did he go? He went to SBI. It's a bank that he has trusted all his life, did all his banking business there. And he went and asked in the branch, I want to put some money. And they gave him an NFO, a mid-cap 150, momentum 50, whatever was available at that time. Guess what? The past returns looked great. That is when the scheme was being launched. He was made to invest without any consideration for his risk profile, right? His other assets. And in 6 months, the markets were down and out. He sold it. He's never ever going to come back into equity. Right? So commission leads to not just bad advice, it ends up adding too much risk to the portfolio. Because the person is getting paid only when you buy more and more products. So they will try to sell you more and more products. Investor has to learn to find someone who can say no.
Correct. And what is the solution to this problem?
Well, one solution is to actually change the model. Right? Have the investment advisor work for the client and not for the product manufacturer. If they charge the client and they are legally obligated to work for the client, no such incentive is there for the advisor to sell more and more products and add too much risk to the portfolio. Right? So the model in India is the SEBI-Registered Investment Advisor. To be a SEBI RIA, you need to have a degree. You need to have good knowledge of finance and pass 2 qualifying exams, which have negative marking. Right? So that model should grow up, but unfortunately, there are less than 1,000 registered investment advisors in India.
Only 1,000 registered advisors for like 5 to 10 crore investor audience?
Yeah.
And that is where you want to solve it through technology and AI?
Correct. I mean, look, there are 40 crore households. Probably 10 crore of them have something to invest, right? There is no way 1,000 registered investment advisors are going to work.
Absolutely.
The only way to solve it is via technology and AI.
But in terms of AI, I personally do not really feel comfortable in terms of, giving my portfolio. I mean, my example, I gave my portfolio to GPT and, something random came out. It was not at all trustworthy. So can I really trust AI with my financial decisions?
So look, when most people talk about AI, first of all, you're absolutely right. You can't just take a portfolio, dump it into GPT and expect to get great results, right? So what is needed is, you have to build an agentic AI, right? There have to be well thought out agents sitting behind the AI. AI is actually talking to the user, figuring it out with them and driving clarity for them. But on the back, it must be powered by powerful agents, data models. This is basically the AI has to be able to learn about what is actually happening in the market, to not dream it up, right? So this requires good old data pipelines to munch the data, make it available. You have to build a knowledge graph out of it. You have to have good financial models to actually figure out, hey, what is the psychometric risk? How do you get the asset allocation for the user? And what the GPT, the LLM part is doing is actually having the conversation with the user and running through various what if scenarios to figure out what is the right thing to do. And so building this is hard, but that's our endeavor, to build an advisor which is in the top 10% of all advisors.
Got it. I understand a bit about hallucinations, but LLMs have really advanced. But in terms of maths, finance, I don't know. I mean,
Correct. Yes. So this is what is happening. Technology is moving at a very rapid pace, right? LLMs have now reached a stage where they are as good as 12th graders in a lot of domains. They are as good as a graduate student in some domains. And they have even reached expert level in a few domains. And it takes work and effort, both on a foundation model and the training side. And our effort is to train AI to have that for finance.
got it. Sounds very interesting, and I would love to see AI being actually, making decisions, helping me make decisions rather than just being a wrapper. But let's jump back into finance. So I keep hearing about FIRE nowadays, thanks to social media. But what does financial independence actually mean?
So FIRE is an interesting word. It stands for financial independence and retire early. Now, I won't comment on the retire early part because that's a personal decision, right? But financial independence is very interesting. Financial independence happens when you have enough assets to cover all your future needs. If you wanted to buy a house, sending kids, to college, vacation, spending your retirement, once you have accumulated enough assets, you don't need to work for money. And what that gives you is it gives you time, control over your time. See, time is the one commodity that you cannot just go out and buy. Right? We have finite time in our lives.
True.
So when you get financially independent, and we call this the FII number, financial independence number, you can do whatever you want with your time. You can go, retire on a beach in Goa, surf every day. You can go work for that NGO. You can do that startup you always wanted. And that is the concept of financial independence.
Got it. And you talked about financial independence number. What actually goes into this financial independence number?
Three things go into it, right? What are your assets? What are your needs? Your spending needs in the future, like I said, buying a house and so on, and your future cash flows.
Got it.
Right. How much, till what age would you be earning? How your income might grow? That is future cash flows. So if you put all of this in Otto today, and you can experiment with different models, you can actually see your FI number for different scenarios.
Got it. And you need only my net worth, assets, and needs. Anything else which might be required?
Assets, needs, and your cash flow projection till your retirement, your future earning potential, what is also called human capital, but not just net worth. See, net worth is just a number. It's the sum total of all assets you own. But what is the breakup of those assets? How much is in equity? How much is in debt? How much is in gold? How much is in real estate also matters. Some of these assets, they move together, right? And some of them assets move differently. Now, historically, when equities go up, gold may not move. When gold moves, or when equities go down, when everyone is afraid, people run towards gold. So they are actually anti-correlated.
Got it. And do these anti-correlated, investment assets, investment classes, hold a lot of value for my overall allocation?
Yes, it does. Right? See, there is a theory by the Nobel Prize-winning economist Harry Markowitz, right, called the MPT, Modern Portfolio Theory. And what it gives us is a way also to assess the risk in the portfolio. So you might say gold will give 10%, I have 10% gold, I have this other thing which gives me this much. You can do a linear sum and you can get, your expected portfolio return. But investing is probabilistic. Year over year, you're not going to get the same thing, right?
Correct.
It follows a range of distributions. And this is called volatility. MPT gives us a way to also predict portfolio volatility given the volatility of each asset class. And this really matters. And this is what is a trade-off between risk and return.
Mm-hmm.
You might have heard this term, risk-adjusted returns, Sharpe ratios.
Correct.
Right? This is where all of this matters.
Got it. And the risk engine which you have built takes care of this market volatility in what way?
So, okay, let me first talk a little bit about our risk engine. Right? Our risk engine is called HA3, Horizon Adjusted Asset Allocation. The inputs to that are not just, your asset allocation, how much of which asset you have, your needs, right? What you may want in the future, your earning potential, your future potential, like how much money would you be bringing in the future. So that's one. That's the user aspect. Then there is, our estimates of how these asset classes are going to do in the future.
Mm-hmm.
There is the volatility, there is the correlation of how these things move. It looks at all these things and then computes an optimal asset allocation for you.
Got it. And can you give me an example of when you say asset allocation?
Yeah.
How does my needs fit into an asset allocation?
Let me pick an example to illustrate this, right? So I have two daughters. The younger one is in 9th grade. She will hopefully go to college in 3.5 years. Let me actually, take a look at the product and then give you the answer. So Otto knows all this data about me. And, okay. So it is suggesting about a 31% equity and 63% debt. And most of the equity is large cap. 85% is large cap.
Okay.
Right? And this is where Otto is actually pretty smart. It has not just estimated that in 3.5 years, I'm going to need a large amount. Her fee is going to be charged every year. So some withdrawals are 3.5 years away. Some are 4.5 years away. Some are actually 7.5 years away. So that because there is something that is 7.5 years away, allows Otto to also add some equity. Because if it did not add this equity component, my returns would be low. Otto has, gone through these trade-offs. Okay. So my elder daughter, 3.5 years to college, 31% equity, and 85% is in large cap. Okay. My younger daughter, she's 10 years away from college. For that, Otto has a 87% equity allocation, 3% debt, and a 10% gold allocation. And out of this, only 57% is large cap. So you see how Otto has smartly taken the needs and the capital market expectations into account. Some time ago, the gold was higher, but it has rebalanced the portfolio and brought it down. Now that gold has run up a lot.
Got it. So
The other thing Otto will do is, as the goal comes nearer, it would dial down the risk in the portfolio.
And why is that dialing down important? Because that need has to be met?
Yeah, see, volatility is, some people say, I don't care about how much volatility is there.
Correct.
They say, I will not care, I will not sell my stock if it goes down. So you may have, first of all, not everybody may have the same emotional control to be able to do it. I know of many great investors who sold out their portfolios in the COVID crash, right? The smart ones actually rebought it in April. But if you really talk to them, they will tell you, okay, I took out some money, on 23rd March, right? 2020. But volatility combined with a liquidity need is a risk. Because what are you going to do? Are you going to tell the kid, hey, okay, go to college next year because I don't really have the money because I put it all into risk assets?
Obviously
Right.
not. So I understand, the needs-based asset allocation. And is that what diversification is all about?
So diversification, you will not realize the MPT predicted returns unless you rebalance. So there's the Harry Markowitz we talk about, he has a quote saying diversification is the only free lunch in investing. Let me give you an example of how diversification helps. And then you can see that when Otto does the rebalancing for you, how does it help?
Mm-hmm.
Okay. Let's pick two stocks A and B, and let's say you put 100 rupees in each of them. Next year, stock A doubles, stock B halves. You have 250 rupees. You do nothing because let's say you're an ostrich investor who never touches the portfolio. Next year, stock A halves, stock B doubles. You end up with 100, 100, 200. You have made net no return in 2 years.
Okay.
Now, let's say you were letting Otto do your rebalancing for you.
Mm-hmm.
I mean, think of these stocks as asset classes, but now what would happen at the end of year one, it would take some money out. It would take actually 50 rupees out. It would take 75 rupees out from stock A, which has done well, and buy stock B. So what you're doing is you're selling high and you're buying low, right? Next year, what happens is, stock A halves goes to 75, but stock B now goes to 250. Your net return is at 25% CAGR in this. Now, it's not always so perfect, but you can see that when you diversify and rebalance, that is a free lunch in investing. It automatically allows you to buy low and sell high without focusing on all the noise in the market.
No, I think this sounds very nice, but in reality, it becomes difficult. And honestly, I mean, all said and done, I would still want to achieve, the financial freedom faster. So, which stock should I actually be picking? You said stock A, B. I would only want to pick the growing stocks.
Well, first of all, I don't know of any investor who can pick only growing stocks.
True.
There is no genuine portfolio, which does not have some things in negative. Because if you see a straight curve producing spectacular returns, that's basically a fraud.
Okay.
So now coming back to your real question, which stock should you buy, right? So Otto does not suggest stocks.
Okay.
The reason is we believe that stock investing is a full-time job. See, I've done stock investing, so I'll tell you what it entails, right? If you buy a stock, you have to first do its valuation, do the DCF, figure out. You have to read the earnings report every quarter now to figure out what's happening. You have to keep track of the news related to that stock. But not just that stock, you also need to study the industry, because maybe the company is doing fine, but competitors are doing so well, they are gaining market share. What are they doing differently? You need to have a competitive scale. Unfortunately, maybe the sector you are tracking may just have a very bad time. Right? Like if you, let's say you said, oh, I'm just an IT investor in India, you would probably be worried right now, because the market has been dropping 5%, at least for those companies, because of AI related news, right? So then you have to study the whole market, or study at least 4 or 5 different sectors. It's a full-time job. When you pay a mutual fund or a PMS manager, you are outsourcing that job to a full-time professional for a small fee. That, we believe, is the right model.
Understandable. And
But that said, Otto does provide some things even for stock traders. Okay, so now you can go and look at it. First of all, your asset allocation would still be visible. See, there are different drivers of returns. The biggest driver of return is asset allocation. Where are you putting the money? At the next level is security selection or scheme selection in case of mutual funds within each asset class, right? The third is actually patience, right? But those are psychological drivers of alpha that we will not discuss. But if you are a stock investor, you come to Otto, you can still see your overall asset allocation, whether you're taking too much risk. If you go to the portfolio view, you can see, your portfolio's average price to book, average price to earnings, to see how much risk you are taking in the portfolio.
got it. No, I'm happy to hear that, because I would say me as an investor, do both stock and mutual funds. And I understand the advantages of mutual funds to some extent. But, I would love to understand, which is the, problem which I also face. There are so many mutual funds to choose from now. How should, one go about that?
It's absolutely right. There are more than 2,000 mutual funds in India today. And I would say probably about 50 to 100 get added every year. That's the rate at which that is growing. What most investors end up doing is they'll end up sorting it by the last 1 year return or last 3 year returns and pick the winners.
Yeah, that's what I've done.
So this is, what has been called the sorting investor, and you should not be a sorting investor. You need to look at way more parameters to figure out, how actually a fund is and what does it do. So at Otto has an algorithm called RAM, which is used to rank mutual funds.
Got it. And what does this RAMP model do?
So RAM stands for, it's an abbreviation. R is for risk. The first thing we look when looking at mutual funds or a scheme is how much risk does it take. Right? One good example is down capture ratio. How much does the fund fall when the market is falling? The second thing is alpha. Ultimately, if you're going to invest in an active fund, you are doing it to beat the index. So alpha is important, right? But not more than risk. Okay, so risk comes first, alpha comes second.
Agreed.
M stands for management. A fund's management also determines its long-term trajectory. A fund may have small, near-term hiccups, but the long-term trajectory depends on the management. So we have ways to estimate managers' ability to add alpha. We look at processes of each fund house. We know the number of analysts. So there are certain fund houses who are probably covering 300 to 400 stocks because they may have fewer analysts in-house. There are certain fund houses who have 12 to 17 analysts and they cover 700 to 800 stocks. And as the Indian markets have become wider and deeper, they get to do better security selection. Right? The P stands for portfolio, RAMP, Risk Alpha Management Portfolio. We look at the portfolio metrics, like what is the churn? Is there excessive trading happening? We look at the earnings quality of the portfolio, and we can also look at other metrics like the ROCE of the portfolio and so on. So combining all of these, Otto produces a ranking, and it is not I would say it's not a complicated to understand. It marks funds as consistent, volatile, good returns but risky, hold, which means funds are somewhere in the middle. They may go up, they may go down, and then some it determines as being poor.
Got it. I think I would check out the app for the same. So you talked about HA3, RAM, all these models. Are these actually available to the mass audience, the mass affluent investor, or are these behind a paywall for HNIs only?
So some of these are actually institution grade models that are simply not available to a retail investor, and most often not even to HNIs. Okay?
Wow.
So there is pretty much no offering which makes something like HA3 available to people, getting a personalized asset allocation. Okay, and the RAM model, some people say we rank mutual funds, but it's a human analyst sitting and rating, and it sits behind a paywall. Even the affluent do not get access to such models because largely they are approached by commission-led products. Of course, selling commission-led products, AIF and PMS to HNIs is more profitable than building all this and then making it accessible to them.
And you are giving all this for free?
Yes, this much we believe should be free for everyone. So this much is free, yes.
So what's not free? Because you will need to earn as well, right?
Correct. So this much is free. I fundamentally believe that if people get to know this much, they can get to the right asset allocation. They can use passive funds to cover it. Of course, there's a step up, right? And that's what people pay us for. I'll give you certain examples. Now you can start throwing in more asset classes like REITs, international. And this is why we operate as a SEBI-Registered Investment Advisor, so that we can incorporate all of these things and we are not just restricted to mutual funds.
Got it.
The second thing that people pay us for is better risk control. Right? If you want to have only a 5% chance or a 10% chance of doing this and understand really, okay, can I design a custom portfolio? There's something called expected shortfall, omega ratios, which are all used to construct things. So those are all advanced features that we would charge for. And then, of course, there's the ease of execution. Right? Remember, I told you that we can give advice, but people may not go and execute it.
True.
Because their emotional things get into the way. Now, if gold has gone to 5,000 and we tell them, look, your gold allocation was only 10%, but it is now sitting at 25%, please dial it down. You think they are going to go and willingly do that transaction? Probably not.
No.
Right? But, this is why the rebalancing and some of these other features and execution, right? Ability to execute that with one click is what people pay us for. So these are all upcoming features. Some are in offline. And there are some people who actually want a human advisor. So we also have an offline desk with an AUA-based model for people who are willing to pay for it.
Understandable. And from what I understand, you are actually covering the mass retail investor, but there is an offline desk, as you said, which will cover the higher, portfolio size clients if they look for that expertise. But who is that ideal user, which Otto is trying to target?
So I would say Otto was built for a slightly evolved investor. People who have possibly been through FNO, people who have possibly tried investing in IPOs and pre-IPOs And they have come to some sort of a conclusion that none of these things, first, these things don't actually work. And second, this should not be my full-time job, right? People, I fundamentally believe, are better off focusing on their primary income, not on their passive income. But you look at it, a disproportionate amount of mind share and time is spent on passive income, even though it's a very small fraction of their primary income. Look at the compounding formula, right? Your final outcome is base wealth into 1 plus r to the power m.
True.
Base matters. How much wealth you end up with is really proportional to how much you put into it. There are people who would give you, SIP 10% step up, SIP can give you this. Yes. But to do that 10% step up in SIP, you need to earn that money. That 10% SIP is not going to come without focusing on your primary income. So once you have understood this, that I do not want to put disproportionate timeshare on my passive income, I am better off focusing on my active income. I want to filter out the noise, and I want to be disciplined and not chasing every fad. Those investors is precisely what Otto is built for.
Very interesting. So, for someone who is early into this investing journey and may not have that much savings, what can Otto, help with?
Well, if you don't have that much savings, I would personally say spend time investing in yourself and increasing your primary income. That's the best thing you can do for yourself. There are two other things that you should do. One is you should look at your expenses and figure out where are you spending too much. Otto can help. Once you have linked your bank accounts with Otto has access to your statements. You can actually go and ask, how much I'm spending on Swiggy.
Oh, nice.
The reason I remember this question, we actually had a user who ran this query, got an answer of 28.5 thousand per month. Next time I met that user had hired a cook to bring down these expenses.
Makes sense.
The third thing you need to do, you can still ask Otto, where should I invest? And Otto will give you a 100% equity portfolio.
Got it.
And this advice is free. If you are young and you have a lot of working years ahead of you, just put money in equity. And there will come a time when you would need to move some into debt and gold, and Otto will advise you accordingly. But you can have the association today, analyze your expenses, start putting money. You don't need to pay anything for that. And as you grow, Otto will adjust your finances accordingly.
So, any last word to the huge investors in India?
I would say download Otto today. Right? Put your finances in, find your fee number, get clarity on your portfolio, get optimizations and insights into your portfolio, and go and take those actions. That's the best gift that you can give yourself.
Thank you, Apurv. Pleasure talking to you.
Thank you, Manish.